few people have posted, and I don't track this super closely, but a few people have posted that the outstanding deltas are particularly large coming into the June quarterly expiry at the moment, both at the index level and the individual stock level. I just wonder, can you share any insights that for what people might expect over the next week or so?
Can you just describe what we mean by outstanding deltas for those that are starting to get into the world of options?
Yeah. So, when we talk about dealer positioning in the vol space, we're talking about how broadly, the dealers are the banks or the market makers, right? The individuals who are taking on liquidity and hedging it. They're, asking for some level of relative value edge. They're holding that relative to other positions. But broadly, most of the street is positioned the same way because they are ultimately absorbing that liquidity. That positioning leads to certain effects as time passes. For example, as a simple example, if in the June expiration, everybody was, all the dealers were short the 36 half put, 3650 put in the S&P 500, they would need to be short stock against that, right? And let's say it was a 10 delta. I'm just making all of this up, but just for example. And so all that stock that they're short against this decaying option will eventually go to zero at June expiration. And not just at June expiration, as vol compresses dramatically, right? And those options go to very small options in one form or another. That delta disappears, right? And they will need to buy back that delta, right? Those are broadly what we call VANA and charm effects, which, charm is the change in time and its effect on options, right? VANA is the change in vol and its effect on options, the delta buyback. Gamma effects, which people are more familiar with, is if you get towards that 3650 put, it becomes a bigger and bigger delta. It may go from a 10 delta if you go to 3650 to a 50 delta. And as the market moves, dealers also have to balance accordingly. So it's this reflexive game, and it's not if the market goes nowhere reflexively, they have stock to buy, so it supports the market. But if the market then starts to decline and goes quickly to the strike, especially towards expiration, becomes more volatile. So during these times when dealer positioning is big, it changes the distribution of outcome. Everybody always turns to me and asks me, so what does that mean? Is the market going up or down? What's going to, the answer is not, that we're going to go up or down. It's simply that the distribution changes. It becomes, if people are short the 3650 put, you get a much fatter tail, right? The gamma effects are much bigger and it can be reflexively very dangerous. But in the absence of that, you have decay, which is a natural kind of buyback of stock that happens over time. So it makes things much more right biased. So the distribution changes based on dealer positioning. And so it's not always about being long or short. It's about being, both maybe long and short, but in the right places, in the right part of the distribution. And I think that's an important thing to understand. But dealer positioning.
It's the difference between outcome and distribution. It's been working for me, talking about Doctor Strange. Yep. And that last scene of the Avengers when he goes in time and sees all the possibilities, right?
Yep.
You just have to kind of position yourself for all possibilities. He, of course, decided on one possibility, but you need to understand that there's many outcomes. And
I've talked about
yourself long and short in different ways to maximize the opportunity set and the change of possible outcomes across that distribution is what you want to actually do.
That's exactly right. It's actually way harder to predict up or down. Just broadly, it's easier to predict distribution or certain informational pieces of that distribution, and it's actually even more valuable in a sense. Most of the asset managers in this world come to it from a place of cash flows and fundamentals and long stocks or long bonds, right? That's just naturally kind of how this world has come to be. Mm-hmm. But our argument broadly, and people even call options the derivative, right? They're a derivative of the underlying. But we very much believe, that derivatives represent the full distribution. Options represent the full distribution and are much more representative of the actual entity and its potential outcomes, right? I mean, you could have two stocks from the same industry, same market cap, you have no name. And from a stock perspective, you'd say, oh, these are the same stock. But one could have a very fat left tail and very right biased, and the other one could have just a normal distribution. And they could be completely different stocks. Ultimately, they have the same expected value, which is what the stock value is, what the market cap is. And so stocks, in our opinion, are actually the derivative of the distribution. They are the expected value of a much more complex and rich set of information, which is the distribution of the underlying asset. And I think that's, a lot of people are waking up to this, even if they don't fully understand it. The fact that they can bet on, with leverage on an outsized outcome to the upside or downside is, in a sense, that realization that you can bet on, the relative value opportunity of a tail outcome and get, the more precise, small price bet that pays off in a big way. And so these
one
nonlinear
that you're going to lose most of the time.
Correct.
But if you make that bet over and over and over again with the right price, you're going to make a positive P&L, right? A positive expectancy return.
Right. And I think this is why we're seeing a big, people will argue with me, but why we're seeing a secular increase in, options trading. It's a superior product. I think it's hard to debate that. There's less liquidity, and that liquidity is increasing. But I think of it as a better technology, right? We're hitting a tipping point. There's more liquidity. There's more products. There's more education. There's more access broadly. All of this is leading to, again, we've had a linear factor exposure. ETF for every factor exposure, every style. That's almost comical to me in the sense that people are still playing in two dimensions on everything when we have the ability to bet on a full distribution of all outcomes, which is much more precise. And again, I think people are broadly waking up to this. We've seen secular increases in options trading. That's been, not just secularly increasing, but increasing in adoption for, 25 years now. And it's only accelerating. And I think, moving into a period where we're more likely to get nonlinear outcomes is also helping get us past that tipping point and adopting even more volume. So I wouldn't be surprised if, we've already seen periods now where notional trading volume is bigger in options than actual stocks. I wouldn't be surprised if that continues secularly, and at some point, 20 years from now or so, options trading is something that every RIA and every kind of wealth advisor is doing, structurally.